All right, so let's jump into Chapter 10. Okay, we'll talk about capital structure, leverage, using leverage in P&C, and we'll actually borrow some wording from Uncle Warren to help us talk about financial leverage in property casualty industry. Cost of capital, we'll look at that from, if you write in the text, we have cost of capital, your dividend, your capital asset pricing model, your dividend growth model as ways to calculate cost of equity, your yield to maturity as a cost of equity or cost of debt, and then this weighted average cost of capital, and then some risk-based capital system, and talk about economic capital. When you get into weighted average cost of capital, once we take a look at that formula, I think you all have probably at one time or another in your life previously had to work something either at work or on your own at home alone on your personal finances. You've done a weighted average calculation before. Well, here we're just weighted average cost of capital versus weighted average anything else. So I don't think we'll be able to work through that. So capital structure, again, what do we mean by capital structure? Again, so here's a picture of a balance sheet, just to recap. Remember, you have your assets, short-term assets, cash, securities, accounts receivable, inventory, long-term assets, plant and equipment. That's your total assets. What is this capital structure that is underlying or supporting those assets? Well, it's your liabilities, short-term accounts payable, short-term notes payable, long-term bank notes, bonds, and then owner's equity. So think of liability and equity is the capital that supports your assets, right? Again, other examples of short-term liabilities is bank loans, your trade credit, commercial paper, bonds, mortgages, leases, and other sources, again, are long-term liabilities. Then you have your common and preferred stock. But again, when we talk about capital structures, what is the structure of assets and liabilities that support the assets to the organization? And if you took this similar type of course at a actual college level or university, and actually several years ago, a previous version of this text, they spent an entire chapter just on what is the optimal mix of debt and equity that you should have for a corporation. So here we're spending this chapter looking at a lot of components, capital structure, cost of capital. You could spend an entire chapter just on optimal capital structure, which is fascinating in itself. But is that something you're going to need to know? Well, you'll sleep better tonight knowing that there is an optimal capital structure. Will you need to know for the exam? No, but by golly, you'll have a sleep better tonight having known that there's something called an optimal capital structure. Okay, financial leverage, what is it? Again, it's using the fixed cost, which is going to be debt, to increase returns to shareholders by using debt capital, by raising capital by issuing debt to earn a higher rate of return than the fixed cost of that debt. Well, how does that happen? We'll look at an example of that. But again, it's using fixed cost, essentially using interest expense on debt to increase returns to shareholders to earn a higher rate of return than the cost of that debt. So if you can use debt to generate a higher rate of return to stockholders than what it costs you for that debt, then it makes sense to enhance your capital by using debt versus equity. There are some downsides to doing that, though. It does reduce your flexibility that management has in managing your cash and increasing your liquidity. Actually, it can decrease your liquidity. So additional debt reduces flexibility. It increases your liquidity risk by increasing the amount of cash flow required to pay debt holders. Same thing if you go out and buy a car, or you own a car and it's paid off. Well, now you want to go buy a new car and you go out and get a loan for that. All right, so that additional debt reduces your flexibility in managing your cash. It increases your liquidity risk because, why? Now you have fixed cash flow that you need to service that debt. Well, same thing for a company, it works the same way. So there's some benefits to leverage. You can increase the rate of return to your stockholders, but there's also a downside to that, and it reduces your flexibility because of the fixed, essentially the debt service expense that you have. Again, this is just a quick stroll down memory lane. Remember Chapter 3, where we talked about the profit margin, asset turn, multiplier. Remember how you calculate return on equity. And then DuPont identity is just that return on equity kind of broken down into its component parts, which is nothing more than your profit margin multiplied by your asset turn multiplied by your equity multiplier. So will you, I mean, when we've looked at the various exam problems that we've done on chapters 3 and 6, I mean, do you need to know how to calculate return on equity? Yes. And it's easy, just net income over total equity, return on equity. So you know equity's got to be in that equation somewhere. And what's your return? Well, that's your net income. Just net income over total equity. But if we want to get 3 for 1, then you look at that DuPont identity and understand that's just your profit margin. Net income over sales. In insurance speak, profit margin is kind of like, what would we kind of refer to, what do we refer to when we kind of talk about a profit margin?
Shareholder equity.
All right, yeah, no, okay. Not quite shareholder equity, but what are you saying?
Combined ratio.
Combined ratio, or what are, right, or combined ratio, or net income, right? Over,
I'd like to say underwriting profit then.
Right, underwriting profit. We kind of equate that to underwriting profit. How do we talk about underwriting profit? Well, we talk about it in terms of a combined ratio. Then you have your asset turnover, and again, that equity multiplier. And remember, asset turnover, think of in terms of you have a company or an industry that has a high amount of fixed assets relative to their total assets. They're going to have a lower asset turnover. So a public utility company that has a high amount of fixed assets, plant and equipment in their asset structure versus a Walmart that has mostly inventory. Well, Walmart has it, they want to turn over that inventory versus you're not turning over, public utility company, you don't turn over your plants and equipment, your power generating plants. So they're going to have a lower asset turnover, they say, than a retail type of industry. So when you're doing financial analysis on a company using what we've learned in Chapter 3, those are the kinds of things you need to keep in mind. Okay, wait a minute, I'm comparing one industry to another. Well, if somebody's got a much higher asset turnover or lower asset turnover, is that bad? No, you have to look at what's that industry and what's the structure of that industry. And then again, return on equity. Because you see that referred, if you open up the Wall Street Journal or CNN Money or go to the Financial Times, you see ROE talked about over and over and over again. If you pick up Business Insurance or Risk and Insurance or National Underwriter magazine, you're going to see ROE talked about. They talk about return on equity. So that is very common in calculation in the financial industry and something that you probably want to know. All right, financial leverage analysis. When the amount of debt financing increases, the fixed interest expense increases. Okay, the amount of debt financing increases. You take out a bigger car loan to buy a newer, nicer car. The fixed interest expense increases. Okay, that makes sense. The profitability is good. You got fixed costs are covered. Fixed costs being your fixed interest expense on that debt. And you have more left over for stockholders, and more net income left over that you can pay out to your stockholders. Conversely, if profitability is bad, certainly you still have to cover those fixed costs. And so then there's less money left over in terms of net income that you can pay out to stockholders. Again, that's just the one component of financial leverage analysis. Right? Some of the other components of analysis, there is some distress from that leverage, right? Well, cost of financial distress, think of bankruptcy costs and selling assets at less than their true economic value. So you can think of companies that you know about, have heard about, that have gone into bankruptcy and they've had to sell those assets at less than their true economic value. I mean, you've all probably been around seeing some retail stores that have a going out of business sale, you know, an 80% off. Well, they're probably selling that merchandise at less than its true economic value, but that's some of the distress costs from taking on perhaps too much leverage. So as a result of selling assets less than their fair economic value or their true economic value, bondholders, stockholders receive less. Right, so picture a balance sheet. If all of a sudden you're selling those assets on the balance sheet side for less than their true economic value, then there's going to be less cash available to your bondholders and to stockholders. And they talk about in the text, certainly as your leverage rises or as your amount of debt rises, so does the probability of bankruptcy, at least theoretically. So there's some negative effect of increasing financial leverage. And what is that effect? Well, it's equal to the present value of bankruptcy costs. And again, once the cost of financial distress is greater than the earnings per share, EPS benefit, the value of the company will start to decline. Earnings per share. How do you calculate earnings per share? Goes back to Chapter 3. Earnings per share. Earnings per share. Well, it sounds like you probably take earnings divided by number of shares outstanding. Earnings per share. Okay, that's it. So, I mean, it's earnings per share. What are my earnings, i.e. net income, divided by how many shares I have outstanding. Okay, well, that's a pretty easy calculation. Here's my net income, earnings, how many shares do I have outstanding, do the division, and my EPS. You see that a lot when you open up financial publications. They talk about companies' earnings per share. Let's see, so we're halfway, almost say halfway into the fourth quarter. So right at the end of the third quarter, so in the, we're seeing it now, even companies are coming out with their third quarter earnings per share announcements. And then we'll see it, then we'll certainly see it in January where people come out with their full year earnings per share. Just as a side note, part of the challenge in earnings per share, earnings divided by outstanding shares. Well, how many shares do I have outstanding? And does that include, if I have treasury stock, do I include treasury stock? If I have a company like Google that gives their employees stock options, what if all those employees exercise their stock options and all of a sudden that stock that they're holding an option becomes outstanding? Well, then you can have diluted earnings per share. They call it fully diluted earnings per share. So Google would take, here's our earnings per share, here's our earnings divided by shares outstanding. Then to get fully diluted earnings per share, here's how many potential shares could be outstanding if employees exercise their stock options, selling the stock out into the marketplace, then you come up with a different EPS calculation. But again, so the cost of financial distress is greater than the earnings per share benefit. Well, okay, well, what's the benefit of earnings per share? Well, then you have to look at, well, how many shares do I actually have outstanding? So there's different ways of calculating that. Financial leverage in property casualty industry. Remember, we have surplus, right? Surplus for P&C is equal to what for the retail industry?
Return on equity.
No.
Shareholders' equity.
Shareholders' equity, right? So think of a balance sheet, assets, liabilities, surplus for property casualty industry versus assets, liabilities, and owner's equity for the retail industry, for Walmart, for example. So surplus for insurance is essentially equivalent to shareholders' equity on GAAP under generally accepted accounting principles versus surplus is under statutory accounting principles. Investment income from unearned premium and loss reserves, right? So we take in the premium and loss reserves and we get to invest that. So again, that helps, we get some investment earnings from that. So insurers write more policies and that is equal to an increase in debt. So how, by insurers, by GEICO writing more policies, are we increasing our debt? You say, well, wait a minute, well, why do we want to write a bunch of new business then? Because we're just increasing our debt. How are we increasing our debt?
Is it because the cost of getting the policies are recognized up front?
The reserve?
Okay. What were you going to say? Here? Okay. All right. So would it be the cost of recognizing the new business acquisition costs up front? Okay. No, that wouldn't be associated with debt because under statutory accounting principles, we have to expense that expense right up front when that can reduce your surplus. But right, it's the unearned premium reserve. So as we write more business, remember we have to, on our balance sheet, all of a sudden the customer pays us $1,000 cash, written premium on their new business auto policy. So we put a cash, assets, cash goes up by $1,000. Our liabilities, unearned premium reserve just went up by $1,000. We use that cash to invest it. And then we slowly earn that premium. So over time, that unearned premium reserve will go down as we earn that premium. But again, so by writing more policies, you increase your debt, i.e. you are increasing your leverage insurance company by writing new business. Why? Because of the unearned premium reserve. And then as we also know, new business doesn't perform as well as seasoned business. So you're going to have more losses, and now you have loss reserves go up. Also, when you write that additional insurance. So how do you measure leverage in the insurance sector? Well, a couple of different ways. You have reserves to policyholder surplus in insurance speak, which is equivalent to debt to equity ratio, say under GAAP. So under statutory accounting, reserves, or think of reserves as liability to policyholder surplus, which is equity, which is similar to on a Walmart, is going to have debt divided by equity, or their debt equity ratio, and in P&C, it's reserve to surplus ratio. And that leverage ratio may vary by line of business. So think of how can the leverage ratio vary by line of business?
Have insurance written.
Okay, like for example.
Like the liability, they're longer tail, so there's going to be more reserve.
Right.
Versus like a property policy, which is going to be short tail.
Right. So it can vary by line of business, or even within line of business. Think of it on our private passenger auto business. Our leverage is much higher on the liability coverage than it is on the physical damage coverage, just because of the nature of the tail of that line of coverage. So it can vary by line of business, and even within a line of business, leverage can vary by type of coverage that you write. All right, capital structure and valuation. Well, you sell more insurance on a fixed amount of surplus, increases expected return to owners, provided that the cost of that policyholder supplied funds is less than the available rates of return on investments. All right, we'll look at this as an example. Cash flow is invested and should earn a greater return than the underwriting loss, and if so, surplus is increased. So think of that last bullet. We get in money from our policyholders. They pay us a premium. We invest it. We earn interest income or investment returns. We invest it in equity. We get dividends. We sell it. We get capital gains. We buy bonds. We get interest income. So all of that investment income could be greater than an underwriting loss. Now, we try not to have an underwriting loss. But if we had an underwriting loss, but you had investment returns that were greater than the underwriting loss, then you still come out with net income and increase your surplus. So you get companies like State Farm, for example, that may write to 105% combined ratio. But then they think, all right, so 105% combined ratio, but they wouldn't make so much money off their investment income that they can bring that down into under 100%, i.e. make a profit, increase their surplus. But again, if you don't have the investment income to offset underwriting losses, then that formula doesn't work very well for you. All right, so they talked about in the text the cost of funds from insurance. And there's actually a question on the quiz on this. We sell insurance, we get premium, we pay losses. What is the cost of these funds? So this formula, this is actually one of the exam questions for this week. The cost of capital from insurer operations, that's that case of O, is equal to what? Well, 1 minus your tax rate times your underwriting loss divided by your loss and loss expense reserves and unearned premium reserves. You're thinking, oh my gosh, am I going to have to remember that, memorize that formula for the exam? The answer would be yes. Because there was a question exactly on this, and you just have to know how to plug in the numbers. So when we get to that, we'll work through it. But if there's an underwriting gain, then there's a negative cost, which is invested to produce a return. So we'll take a look at this for a second. This thing called float, this negative cost called float. So this is what Uncle Warren has to say about it. We get a premium up front, we pay claims later. And sometimes, as we know, in workers' comp or even in liability lines, those payments can stretch over a long period of time. To get money now, pay later model, we end up holding a lot of money called float to eventually go out to others. In the meanwhile, he gets to invest it. Individual policies to come and they go, claims come and go, but the amount flows relatively stable in relation to premium volume that Berkshire writes. Consequently, as our business grows, so does our float. If premiums exceed total expenses and eventual losses, we get an underwriting profit that adds to the investment income produced from the float. This combination allows us to enjoy the use of free money, or better yet, to get paid for holding it. So what he's talking about right there is that bottom bullet. There's an underwriting gain, there's a negative cost float that can be invested to produce a return. So he's saying, all right, so if we actually make an underwriting gain, we get free use of the money, and better yet, we get paid for holding it. Now, unfortunately, as he says here, the unhappy result is we get a lot of competition as a result of that. So, as a whole, the industry operates at a significant underwriting loss. Now, so far in 2015, the industry is probably going to record substantial profit come the end of the year. Large part due to the lack, really, of any major catastrophes. Now, you're going to get some companies who are going to get taken to the cleaners. Just give an example, when they had the explosion over in China at that big shipping yard, I know for one Zurich insurance company, which is a large multinational P&C carrier, they had a $220 million loss from that explosion. from damaged property that they insured and businesses around there that were damaged or destroyed as a result of that explosion. Certainly, you know, but as a whole, the industry probably this year will have a pretty significant underwriting gain. So when you talk about cost of funds from insurance, how do you calculate it? Here's how you calculate it. But if you actually have an underwriting gain, which is what GEICO strives to do, then you essentially have negative cost of float, or what Warren talks about here is how they actually get paid for holding that money. And how we can use that money to certainly increase the returns to Berkshire Hathaway shareholders. Okay, why is cost of capital important? Well, if you know the return earned on assets depends on the riskiness of those assets. Remember, the higher the risk, the greater the return that you're going to ask for. If you're going to invest some of your 401k money, you can invest it in either a bond fund or you can leave it in a money market fund, right? The money market fund has very low risk because your money, it's not going to go down any. But then your rate of return is what? Almost nothing. 0.5%, 0.25%. So, you know, invested, you put your 401k money in a all-stock mutual fund that mimics the S&P 500, yeah, you got a lot more risk, but then you can also have a potential for a greater return as well. Cost of capital does what? It gives you an indication of how the market views the risk of assets or the riskiness of the business enterprise. And knowing that cost of capital can help you determine your required return for capital budgeting projects. All right. So how do you determine this cost of capital? Cost of equity is what? The return required by equity investors given the risk of cash flows from the firm. How do you calculate it? Well, two ways he talked about in the text are this dividend growth model and this capital asset pricing model. There were exam questions that use both of these models. So if you haven't yet, when you go in the online practice exam, you'll see a question using either one or both of these. How does the dividend growth model, how does it work? Well, it says the value of a share is equal to the discounted value of the perpetual stream of cash dividends expected to be paid. It's a mouthful. But if you think about it this way, you go out and invest your money in some stock. Someday you might sell that stock. But in the meantime, you hope that that stock will pay you a dividend. So what is the value of that stock? Well, it's the present value of those expected future dividends, discounted at some rate of return over some period of time. So the cost of equity is equal to the market rate of return required for the investment, which is also the discount rate that equals the future cash dividends with the current price of the stock. So if you look at stock and if Apple sells for $117 a share, what does that represent? Well, in part it represents, using the theory here, $117 Apple share price is equal to the present value of the expected future dividends on Apple stock, discounted at some rate of return. So how do we do that? All right, so here's your dividend growth model. That's what it looks like, and then you do a little algebra to it, and it reduces down to this D sub 1 divided by R minus G. All that means is the dividend next year divided by the required rate of return minus the growth rate. I think this P sub O is equal to what? The dividend in time 0, or the current dividend, multiplied by what? 1 plus your growth rate in dividends, divided by the required return minus your growth rate. So you take that D1 divided by R minus G, you rearrange it a bit, you come up with this formula on the bottom. which is your required return on equity, is equal to what? The dividend in period 1 divided by the price of the stock plus the growth rate. And that will give you your required return on equity. So, all right, so wait a minute. So you can open up the Wall Street Journal and you can see what the company pays in dividends. You can look in the Wall Street Journal and you see here's the price of the stock. The Apple closed at $117 a share and they're paying $2 per share dividend. I'm making the number up here. Plus their growth rate. You can open the company's financial statement and look at what was their dividends this quarter, what was their dividends last quarter, and the quarter before, and the quarter before, and you can look back for 2 or 3 years and see what did they pay each quarter for dividends. Is it flat or did it increase? Now, how much did it increase on a percentage basis from one quarter to the other? And then you have the dividend next year or next period divided by your initial stock price plus your growth rate gives you your expected return on equity. So we'll look at a problem. Now, you didn't bring a calculator. I'll break up the answer here, but you're expected to pay dividends $1.50 per share next year. The growth rate has been 5.1% per year in dividends. We expect that to continue, and the current price of stock is $25. So you have everything there to answer the return on equity question. $1.50 divided by the price of the stock plus what? The growth rate, 0.51 is equal to 11.1% is your return on equity. So again, that problem right there, D sub 1 divided by P sub O plus G, that $1.50 is your D sub 1, $25 is your P sub O, plus G, your growth rate in dividends. Now, where they will throw you a loop on the exam is that $1.50 is D sub 1. Think of dividends next period. So in this example, they gave us dividends next year of $1.50. On an exam, they would say the current dividend is $1 and is expected to grow at 5.1% into the future. Current price is $25. What's the return on equity? All right, so if you took $1 divided by 25 plus 5.1%, you get a wrong answer. So you have to calculate the dividend next period. So it would be, if it's $1 now and the growth rate is 5.1%, all right, then you take $1 times your 1.051 to come up with your dividend next period and then do the formula. Or they may give you the dividend next period and you don't even have to do that calculation. And you can get the answer right here. So you may see this question on an exam either way. They'll give you the dividend next year that we do here, or they may give you the current dividend. To give you the current dividend, you have to get D sub 1, which is a dividend next period. So you have to do that extra calculation depending upon how they present the problem to you. All right, that's all there is to this dividend growth model. Just dividend next period divided by the current price of the stock plus your growth rate. Now, the fun part with this is you could look at this formula right here and say, all right, and you could go home and look at Apple stock as an example. And you can look up Apple stock, see what their dividend is currently, and see what it's been for the last couple of years. Let's say their dividend has stayed the same. So the growth rate is 0. All right, I'm not expecting they're going to keep their dividends the same. And it's the dividends divided by the price of the stock to get the return on equity required by Apple shareholders. So essentially, rather than telling you the return on equity is X, here you're kind of essentially you're backing into what is the return on equity based off of the dividend and the current stock price. Then you could do that calculation for Apple stock. Look at what their growth rate has been in dividends. Look at the current price of the stock. Calculate next period's dividend. Calculate the theoretical price that Apple stock should be selling for. Then you can open up the pages of the Wall Street Journal and see, all right, is Apple stock selling for that price now, yes or no? And is it higher or lower? Does that present to you an opportunity to go, wait a minute, based off of your calculation, Apple stock should be selling for more than what it is currently, and then you run out and buy a bunch of Apple stock thinking the price is going to go up. All right, so again, that's how you can use the dividend growth model to calculate what? Your cost of equity capital. There are some advantages for it. It's easy to understand and use. It sure is. Well, what if they're not paying any dividends? It's not applicable if dividends aren't growing at a reasonably constant rate. And it's very sensitive to estimates in that growth rate, and it does not consider risk. So there are some advantages or disadvantages to this dividend growth model. So what other model do you have? This thing called a capital asset pricing model. Remember, RF is your risk-free rate. Market risk premium, remember a couple chapters ago, we actually looked at, there's a website from a professor at New York University that calculates the actual market risk premium for different market indices. So that number is out there. It's real. It's available. And so you take this required return on equity is equal to what? Your risk-free rate plus this thing called a beta coefficient, which is that B sub E, times your market risk premium. And there was one of the exam questions online was using this formula to calculate return on equity. So what that model says, the expected single period return on a security is equal to what? The risk-free rate times this thing called a beta coefficient, which is nothing more than a correlation coefficient of returns on the security. Now you won't have to calculate that for an exam. They'll give you the beta coefficient, but you'll sleep better at night knowing how it's calculated. So that thing down below, that B sub J, that's just the correlation coefficient between those two securities. You multiply by the quotient of their standard deviation. So in case you're interested sometime, that's how you calculate a beta coefficient. So when I send out the slides, you'll have this. But again, so that's this capital asset pricing model. So let's look at an example. You have an equity beta of 0.58 and a risk-free rate of 6.1. Expected market risk premium is 8.6. What's your cost of equity capital? You just plug it into that formula, you come up here at 11.1. Now, when they talk about an equity beta of 0.58, remember back, I think it was chapter 5, or was it 7, that we talked about a beta coefficient. So remember, what does an equity beta of 0.58 mean? Anybody remember? What's the beta coefficient? Okay, that's what it is. Anybody remember what's a beta coefficient tell you? And you're probably thinking, well, the beta coefficient is a measure of the systematic risk of a stock, and normally a beta coefficient of 1.0 is equal to the market risk. And so a beta of 0.58, it's a measure of the volatility of returns on a stock. Okay, 0.58. So a company like Walmart, Procter & Gamble, might have a beta coefficient of less than 1. A company like Google or a high-tech company may have a beta coefficient of greater than 1. Again, it's a measure of the degree of systematic risk associated with the returns on a given stock. So you multiply it, you come up with this 11.1, plug it into that capital asset pricing model. And I said, wait a minute, when we use this dividend growth model, we also came up with 11.1. So if you come up with a similar number using both the dividend growth and CAPM, you should feel pretty good about your estimate. Again, you can go to Yahoo Finance, Google Finance, CNN Money Finance, and those websites will actually publish and show you. We can go to Wall Street Journal, it's there too. They'll calculate the beta coefficient for you. We have websites to publish the market risk premium. You can look up the risk-free rate. What is the yield on a U.S. Treasury? Just to give you an example, and we looked at earlier today, the yield on Treasury, 2.226. There's your risk-free rate right there.
When you do the financial models on Vanguard, what's the figure that pops up when you first plug the very first screen when you pull it up? Like mine was like 1.73 or something.
Well, I mean, when you go into financial engines,
Yeah.
yeah, it's calculating a beta coefficient.
Calculate this.
Right.
Okay.
Right. It's calculating your beta coefficient for your holdings. Right, for your investments. Right. So this is easy. There's your risk-free rate. And you can probably go search Google and do a Google search. Easy enough to find out the risk premium. And you know your risk-free rate, 2.226. You can look up on a website what the market risk premium is. And you can also look up on the website the beta coefficient for that company's stock. And you have everything you need to figure out the required return on equity using this capital asset pricing model. There are some advantages to disadvantages. Well, it explicitly adjusts for systematic risk. How does it do it? By using that beta coefficient. It's applicable to all companies as long as you can compute a beta coefficient. There are some disadvantages. You do have to estimate the expected market risk premium. You have to estimate this beta coefficient. So really the only known readily is the risk-free rate. You can go to the wallstreetjournal.com. There's risk-free rate right there we just looked at. But otherwise, you have to estimate market risk premium, estimate a beta coefficient. So if we put all of us in a room and I gave you, Microsoft's annual statement, we would all come up with different estimates of the risk premium and what their beta coefficient is. So again, that's some of the challenges. And again, even using a dividend growth model, well, what's the expected growth rate? Well, over what time period? The last 2 years, 5 years, 4 quarters, 10 years? What time period are you going to use for your calculating a growth rate in dividends? And so you could get different numbers from equally sophisticated analysts depending upon what assumptions they use for some of these calculations. All right, so now we're going to look at this cost of equity. So you got a company that's got a beta coefficient of 1.5, risk premium 9, risk-free rate is 6. Dividends are going to grow at 6% a year. Your last dividend was $2. The current price is $15.65 a share. What is your cost of equity using those two models? You plug in the numbers into each of the formulas. There's your CAPM, 19.5. Your dividend growth model, 19.55. Well, those are pretty close. So you can feel pretty good about your estimate. And again, all of the inputs that you need to calculate a CAPM return on equity or dividend growth model return on equity are all publicly available information you could sit down and pull up on your computer. All right, so that's how you calculate cost of equity. Let's flip the house, let's go over to cost of debt. It's the required return on your company's debt. Normally, you're looking at long-term debt, not short-term. It's best estimated by computing the yield to maturity on existing debt. And you can use estimates of current rates based on bond ratings. Cost of debt is not the coupon rate, right? So if you have a $1,000 face value bond, and you have a 10% coupon, how much are you paying out each year? You have an annual coupon of 10%, $1,000 face value. How much are you paying out in coupon each year? $100, right? That is not the cost of your debt. We'll look at why. So you got a bond issue that's currently outstanding, has 25 years left before that bond matures. Coupon rate's 9%. Coupons are paid semi-annually. The bond is currently selling for $908.72 per $1,000 face value. The cost of debt, or the yield to maturity in this case, is 10%. So conceptually, just think of it this way. If the cost of debt was equal to the coupon rate, this bond would be selling for $1,000. Now the coupon rate is 9%. The yield is 10. So investors for a bond of this maturity, 25 years, and riskiness, the required return in the marketplace is asking or demanding a 10% rate of return. Well, if the bond coupon is only 9% and investors want a 10% rate of return, how do you get a 10% rate of return? Well, you pay less than the face value of the bond. In this case, $908. So by paying a $908 for a $1,000 face value bond, you are yielding 10% return on that. Let me give you pull up an example here to put this into Excel. So there's our bond calculation, right? That first piece there is the present value of your annuity, which is that C is coupon times that annuity factor plus the present value of the face value of the bond when it matures in 25 years. So let's plug this in using this as an example here. You got a coupon rate of 9%. It gives you a coupon of $90 a year, let's say. You got 25 years. The current yield is 9%, same as the coupon rate. Par value, or face value of the bond, is $1,000. And if you plugged all of those numbers into that formula up there, you'd get PV, present value of the bond, is equal to $1,000. But in this example, it's $908.72. So let's go do this. So when they calculate a yield to maturity, well, how can I do that? So let's set this cell equal to 908.72 by changing what? By changing the yield to maturity. For 908.72, your yield is 10.0006. So when we talk about your cost of debt being this yield to maturity, you can actually calculate the yield to maturity just by setting up that bond equation and use this thing. If you haven't used it before under Excel, there's something, go under data. It's called what if analysis, goal seek, and set your cell, that one, equal to our goal. In this case, it was $908.72 by changing what? This yield to maturity. So in this bond formula, that yield to maturity is what letter? Well, what letters do we have in there? Where's that yield to maturity in this bond problem? Is it C? One vote for C? Yield maturity, right, because your coupon payment is $90, so that is C. T is what? Remember in this bond formula in Chapter 6, T is equal to what? Time. There you go. FV is equal to what? Future value or face value, right? $1,000 in this case, right? Face value of our bond when it matures. So what are you left with? Well, you're left with this thing called R. Think of R as your rate. R is required return, or R is yield to maturity. So you know the price of your bond, $908.72. You know what the coupon rate is. Essentially, you can use this goal-seek function in Excel to solve for your yield to maturity. And so by paying $908.72 for a bond that's going to give you $1,000 in 25 years, you are effectively getting a yield of 10% on that bond by paying less than the face value. And in this case, $908 for $1,000. That's the same as coming to you, all right, give me $908.72, and in 25 years, I'm going to give you $1,000. What's your rate of return? Equal to your yield to maturity, which is 10%. All right. Now, for some of you, if you know, if you have a financial calculator, some financial calculators just punch in some buttons and it'll calculate a yield to maturity for you. Are you going to have to calculate a yield to maturity for the exam? Probably not. But certainly maybe you get a question where you have to understand how it works, yes. But when you talk about cost of debt, remember you have to adjust for taxes. Why? Because the interest expense paid on debt is tax deductible to the company. All right, because remember years ago, before the tax reform in 1986, prior to 1986, if you have a credit card and you paid interest on your credit card, you were able to deduct that interest on your credit card. And in the Reagan administration in 1986, they changed the tax laws and they eliminated that deduction. So prior to 1986, you know, that 18% you're paying on a credit card. Well, not really, because you have to calculate the after-tax cost of that debt because you're able to deduct that to get your taxable income. Well, they eliminated that in 1986. But for companies, they can still deduct interest expense, and so there's a tax benefit for companies in doing so. So again, you have to multiply by this cost of debt. Remember we talked from Chapter 7, there's something called preferred stock. It pays a constant dividend every period, and there's no end date, so it's like a perpetuity. Dividends are expected to be paid every period forever. So how do you calculate the return, the required return for preferred stock? Well, it's just D divided your dividend divided by the price of the stock. Gives you your expected return for that preferred stock. All right, then they talked in the text about this thing called a weighted average cost of capital. So we looked at calculating cost of equity using a dividend growth model and a capital asset pricing model. We talked about calculating cost of debt as being the yield to maturity. you can combine those two to come up with a weighted average cost of capital. How do you do that? All right, remember, we're concerned with after-tax cash flows because of the deductibility of interest expense. That's where you get this 1 minus T, which is your tax rate. So there's your required return on debt, or your yield to maturity on debt, multiplied by 1 minus your tax rate. Dividends are not tax deductible, so there's no impact to that. So this thing called a WACC, a weighted average cost of capital, is equal to what? How much debt do you have in your capital structure? How much equity do you have in your capital structure? So the percent of equity times the required return on equity plus the percent of debt times the after-tax cost of debt to come up with this thing called a weighted average cost of capital. So we're going to look at, I have it here. No, I got rid of it. You don't have it. So this weighted average cost of capital is just how much debt do you have times the after-tax cost of debt plus how much equity do you have on a percentage basis times the required return on equity. So if you had 50-50 split, it'd be easy enough, 0.5 times your required return on equity plus 0.5 times the required return on debt multiplied by 1 minus the tax rate to come up with your weighted average cost of capital. All right, also in the text they talk about this NAIC risk-based capital system. The ongoing amount of capital required depends upon the amount of the insurer's risk-based capital. Now we're going through an exercise right now, I think I mentioned in a previous class, where we have a ERISA own risk solvency assessment that we, GEICO, are having to go through. NICO is doing the same thing. General Re is doing the same thing. Most all property and casualty insurers are having to go through this own risk solvency assessment, where some of the components of that assessment are looking at our risk-based capital. What is it? Well, it's developed by the NAIC, establishes a minimum amount of capital an insurer needs to support its overall business operations based on a risk-based capital formula. What does it look at? Well, it looks at asset risk, credit risk, underwriting risk, and business risk. There are exam questions this week that talk about these various categories of risk measured by the risk-based capital system. Remember, asset, credit, underwriting, and business risk. How well the insurer meets these capital requirements determines the degree of regulatory action. So what do we mean by asset risk? Well, riskier assets, those more likely to have a loss or a greater degree of loss, require more underlying capital than less risky assets. Okay, that makes sense. So if you have stock and bonds in your asset structure, right? You invest in stocks and bonds. Well, you're holding the bonds to maturity, and they're A-rated or AA-rated or AAA-rated bonds. You also have a lot of equity. Well, which of those two are riskier, the bonds or the equity? Which do you think would be riskier, bonds or equity?
Equity.
Why do you say that? Is that a lucky guess, or you knew?
Well, no, bonds aren't that risky. Equity would be like your surplus, right?
Well, because we're just talking about assets. So you invest money in bonds. You got to buy some IBM bonds. You're going to hold those to maturity. IBM's AA-rated bonds. You're going to hold them for the next 20 years. Right? And it's coupon payment of 10%. So you're getting your 10% every year for the next 20 years.
Like you're going to get every time. There's no chance in it.
Right. They're AA-rated bonds. That's not a very risky investment. You're holding them to maturity. versus you go out and buy stock. Price of stock can go up and down every day, right? It's very volatile, and a company could say, we're not going to pay dividends. You as an investor, wait a minute, you're looking for dividends as part of your cash flow, your return on equity. Well, all of a sudden they cut off those dividends. So think of it this way, they're looking at asset risk. So the more a company has in equity on their assets versus debt, for example, then they may require a higher amount of capital. Essentially, so if your asset structure is more risky, the more risky the asset structure, the greater amount of capital insurance regulators are going to require you to hold. Why? Well, because you have to use some of those assets to pay off claims. And if a lot of those assets are stock that could drop in value, then regulators are going to want you to carry more capital as a cushion against the drop in the value of your assets. They're looking at credit risk, possibility that an insurer will not be able to collect money owed to it. So just think of it this way, with GEICO, we write lots of business, lots of policies, right? And some customers may not pay us the premium that they owe us, right? So we have a bad debt expense. So the possibility that an insurer will not be able to collect the money owed to it. That's why we don't like bad debt. One, just like anybody else, you want your money that's owed to you for, in this case, the coverage provided. But also, if the larger the amount of bad debt that we have on our books, then from a regulatory standpoint, that can increase the amount of capital that regulators could require you to hold because of this risk-based capital system. They're looking at it. Underwriting risk. Ensure that it's risk of underwriting loss, the premiums charged or loss reserves are too low. All right, well, we need to make sure we're underwriting, and we try to get an underwriting profit, not an underwriting loss. There's underwriting risk. So they may look at a company like, like Zurich, for example, that is operating at a combined ratio greater than 100. Underwriting risk. Versus GEICO operates at a combined ratio less than 100. We don't have that underwriting risk. And the other one I have in here that I don't have up here is business risk. So think of it this way. Business risk, a company that writes property insurance in the state of Florida. And if 90% of their PIF is Florida property versus a company that writes property coverage nationwide, who's got more business risk? Well, certainly a company that's concentrated essentially in a catastrophe-prone area. All right, authorized risk control level. Again, authorized control level at ACL, company action, regulatory action. So you can see here, company level, for if the ACL is between 150 and 200, then there's no regulatory action. Then as you get down, further down, for your authorized control level, see, then they must liquidate or rehabilitate if you're at the very bottom. So again, so the NAIC and companies actually calculate, we calculate, GEICO, our risk-based capital. Because we want to be at the very top level, where there's no action really required by the company and no regulatory action. We don't want to be at the company level. We have to submit a plan, raise capital, reduce risk. We'd rather not be in that position. But again, so the NAIC has this risk-based capital system that they developed to monitor and to determine the amount of capital and also regulatory action or regulatory intervention into a company. All right, tell you what, it is 10 after. Let me hold there for, we'll take a 4-minute break and then we'll come back. It's been going an hour and 10, so let me give you 4 minutes and then we'll pick it back up here with economic capital. All right?
So we're only doing the class 2 weeks from now, or is there going to be like another class after that with exams or something?
No, we'll do the class in 2 weeks because we don't have to, we'll do no class next week. Class the following week, we're going to do chapters 11 and 12. Those are relatively shorter than, say, this chapter. And we won't have a class after that, like to do an exam review, because your exam review is right there online.
Yeah.
Yeah.
So that'll be it then?
That'll be it. So we'll be done before Thanksgiving. And so that way, if over Thanksgiving you get tired of eating turkey, you can always pick up a CPCU book. It'll be the height of conversation around the table, I'm sure.
As long as I don't have to work.
Look at that. Now, we're actually looking at the futures market. You can see right now also the S&P 500 futures. Again, the market closed at 4 o'clock, but the futures markets is trading up. It's up 0.3. So it's not up even 1 yet. 0.01. So is that going to give you an indication that, hey, tomorrow the market's going to be in green territory because the futures are green now? No. Exactly. Yep. Absolutely not. So don't run out and buy stock yet. All right, so we'll dive right back in, talk about economic capital. What is it? So again, we talked about cost of equity capital using dividend growth model, capital asset pricing model, cost of debt using the yield to maturity as an indicator of the cost of debt, the weighted average cost of capital, where you just combine the percentage of equity times the cost of equity plus the percentage of debt times the after-tax cost of debt to come up with a weighted average cost of capital. Know that the NAIC RBC risk-based capital system, right, looks at what are the 4 components that the RBC looks at?
Asset, credit, underwriting, business.
Right, okay, there you go. Now we have this economic capital. What is it? It's the estimate of the amount of capital firm needs to remain solvent at a given risk tolerance level. It differs from other types of regulatory capital because rather than being based on a formula, it's based on the fair market value of assets and liabilities as well as their variability, which seems to be a little more nebulous because what is the fair value of assets? And that can fluctuate on a daily basis. And what is the fair value of liabilities? We use this concept of fair value accounting. What's fair value accounting? Well, assets and liabilities are valued at their probabilistic values.
Is that a real word?
Probabilistic?
Yeah.
Yes. Essentially, I mean, just assigning a probability distribution to the value of assets and value of liabilities. Of course, the problem is, what is the fair value of liabilities? What are the values, what are the liabilities for an insurance company? Go ahead.
The risk that they write a premium for.
Right,
Reserve and unearned premium reserve.
right. So loss reserves and unearned premium reserves, right? Those are our largest liabilities. What is the fair value of liabilities? So what's the fair value of our unearned premium reserve? Well, all right. I mean, you could maybe put a calculation, a distribution around that. Unearned premium, right? Well, you write an annual policy, and here's our unearned premium reserve, and so we're going to earn 1/365th of our commercial auto premium every day over the course of a year. Here's how many policies we have. Here's the premium. You can fairly guesstimate that. But what is the fair value of liabilities? Well, you don't know what your liabilities are, all of them, because you don't know what your losses are going to be. You know what your losses are as of right today. That probably doesn't include IBNR, incurred but not reported. And then you don't know, even if you know the claims that came in today, you don't know what their ultimate value is going to be. So there's certainly some challenges with this concept of economic capital and calculating what is the fair value of our assets and liabilities when those, especially the liabilities, may not readily be known. And remember, under GAAP, net worth is called equity. SAF, it's called surplus. And then fair value of assets, or using this economic capital net worth, is called market value surplus. And that's it for Chapter 11. Or Chapter 10, next week Chapter 11, mergers and acquisitions. And then Chapter 12 talks about underwriting cycles. So again, we'll cover those two chapters. No class next week, and we'll cover Chapters 11 and 12, I think it's the 18th of November. And with that, then we will be done with this, and you'll have lots of time to study for the test.
I think every CPCU course covers the underwriting cycle.
Every CPC course, underwriting site, yeah, somewhere in there they have some discussion about it. Right. All right. Let's take a look at the quiz for this week to get you some flavor for what we're going to be looking at. Let me refresh that to make sure it hasn't logged me out. All right, let's give this a shot, see how we do. Management must be aware of what cost of capital is to their company. When multiple sources of debt, equity, preferred stock are used, how would they best calculate? They should use a weighted average cost for all sources. Okay. You think A?
Yeah, I think A.
Okay.
All right. See how easy this is? All right. Writing loss, $1. Loss and loss expense reserve is $30 million, unearned premium of 10. They got a 30% tax rate. What is their cost of funds from insurance operations?
Sounds like a formula question.
Sounds like the formula. So you're probably thinking, all right, well, that formula is what? It was 1 minus your tax rate times your underwriting loss divided by what? Your loss and loss expense reserve minus your unearned premium reserve. All right, so you can take 1 minus T being your tax rates, that's going to be 0.7 times 4 million divided by, in this case, 30 minus 10 is going to be 20. So you essentially take 70% of 4 million divided by $20 million. Now, if somebody has a calculator, come punch that up. Let's see what we get. A. What'd you come? How'd you come up with 7%?
There's 5 million, 30 million is 40 in the bottom. If we just use the formula and just put in the numbers, they all did.
Okay.
1 minus 0.30.
Right.
Times that number by loss, which was 4 million, divided by 4.
Plus, okay. Good, 7%. All right, let's go with that, see where we end up. All right. Which of the following is the reason why operations underwriting to provide insurance leverage?
B.
B.
Did you say we take 30? You take
Right. No, I misspoke. It's 30 plus.
30 plus.
Right.
That's why I got
Yep. All right. So this is Manufacturing Corp. They want to raise capital by $70 million with a $100 par value, preferred, and 10% dividend. Sold at $90 a share. What's the cost of raising? What do you think? What is their cost of raising capital? Came up with C.
I don't have a formula, but that's what I think it is.
everything rounds out.
Everything rounds out tonight. Okay. You want to go with that? All right. All right. Based on the following data, manufacturing, which of the following would be a break-even point of earnings before interest and taxes pivot between debt financing and equity financing? So you look at this saying, oh, what? Wait a minute, how do I calculate? How do we even start with that? So let me help you out on that, show you how this works. I'll send this file out to you as well, so you'll just have it. So essentially, you're trying to calculate, it's asking you, what is the number here? What is the optimal amount of earnings before and tax? The answer is 100, 400, 500, 600. So really, the difference here is here you have equity. So EBIT, I will start with 600. It could be any of those numbers you start with. Interest expense is 0 under equity. So your net income is 600. Here, your interest expense is 200. So your net income is 400. How many shares do you have outstanding under equity? Well, I have 100. The present number of shares outstanding 100. They're going to issue additional 50. So now I'd have 150,000 shares outstanding under equity. I'd only have 100,000 outstanding under debt. Really, it's earnings per share. And under 600,000, so essentially I'm taking net income divided by shares outstanding to get my earnings per share. And that net income is either 600,000 or it's 400,000 under debt. And you see where the difference is in earnings in the number of shares outstanding. So let's go and even get rid of that. We don't care about it. We're going to go and just really, we don't even care about that. What matters. So let's show you an example. So if you put in 500 here, your earnings per share at 500,000 is 3.33 earnings per share, or 3 under debt. So they ask you, what is the break even? So how you calculate this problem, if you're looking at this on exam, you didn't have Excel to do this in. So wait a minute, how many shares am I going to have outstanding under equity versus debt? You can see the difference there, 150 versus 100. And then what is my net income under the different scenarios? What's my break-even point? Let me pick one of those. Well, if I know my interest expense is $200,000, it's probably not going to be A. That's $100,000. Throw that one out. $400,000. Yeah. Maybe you're probably better with a higher number since your interest expense is $200,000. So you get to pick 500,000 or 600,000 and do the calculation. So how you solve this is, what is my net income based off of one of those IBITs, say 500,000 or 600,000? How many shares am I going to have outstanding under an equity versus non-equity offering? 150,000 shares versus 100,000 shares, and calculate your earnings per share. Figure out what is the break-even EBIT, and we find if you plug that in, your break-even EBIT is 600,000. So how you tackle this problem on the exam, right? I know the right answer is in front of me. It's not going to be A. Probably a higher number is going to be better. So let me pick 500,000. Let me pick 600,000. Either one of those start with. What is your earnings? What you want to do is, what is your earnings per share, and find out where are the earnings per share. What IBIT will give you an equal earnings per share. But in order to calculate that, you have to see how many shares am I going to have outstanding under an equity structure, 150,000 versus a debt, only 100,000. Really, that's how you tackle this kind of problem on an exam. Try that. All right, let's look at 6. Which of the following is a measure of the loss uncertainty of the insurance sold by an insurer? Which one? D, underwriting risk? Okay. Lots of advantages associated with economic capital analysis. One of these is what? D, all right. Like pretty short of the answer there. Let's go to 8. Risk-based capital model addresses 4 categories of risk, including asset risk. Asset risk is the what? Which is always an advantage of being a common stockholder over a preferred stockholder? B.
Is that B?
They exercise control over management. How do they exercise control over management?
Voting
By voting?
rights.
Okay. Okay, all assets involve some amount of asset risk. Which of the following is true about risk-based capital formula with regard to asset risk? Okay. All right. Let's go next. Treadwell Insurance has a ratio of premium written to surplus 2-to-1. Reserves of $1.60 for each dollar in premiums. What is their insurance company leverage? do you think? But if you're looking at this and say, I don't have a clue, if you're not even sure how to calculate it, I'll let you look at your book. You can go to 10.10. That's how you calculate that insurance leverage. So you see, so looking at that formula on 10.10, and the numbers you have up in front of you, put what numbers are you going to put that numbers into that formula? What are you going to have where? What? How'd you come up with that?
Basically, it's just, 2, 1.6 divided by 1.
Okay. All right.
Would it be their reserves is $1.60 divided by the premiums written is $1, so that's 1.6, and then you have the surplus of 2 to 1, so 2 times 1.6 is 3.2.
Okay. Well, I'm two equally sophisticated analysts come up with the same answer. So take that and go on. Economic capital is what? B, the amount of capital required to maintain solvency at a given risk tolerance level. Okay. Everybody agree with B? All right. Let's look at the stock of Reynolds Corp. Have been growing at a constant rate of 4%, and they just paid an annual dividend of $4. Investors want a market rate of return of 7% and then current inflation of 1%. What's the price of their stock? How are you going to calculate that? What model are you going to use to calculate that? Now, let's see. What do you think? How are you going to tackle that problem? What do you think? This could be you tomorrow going out and buying some stock. How much are you going to pay for this? Can you use a capital asset pricing model? And you're probably saying, well, of course not, you can't, because we don't have a beta coefficient, we don't have a risk-free rate, right? So what do you know? You know that the current dividend is what?
$4.
All right. And you know the, okay. So what do you think? Do we have an educated guess?
If I had to absolutely guess, I would say it's either B or C because those two numbers are closer together, and I would guess C. But that is based on absolutely nothing.
The toss of the darts, right? Okay. Anybody
Well,
else?
I think that B is like a teaser answer, and then you should have actually plugged something else in to see the correct answer. But again, that's not based on anything at all. So.
All right, let's go there and see. All right. Leverage analysis, the technique for comparing earnings per share. Remember back when we looked at Excel spreadsheet, we looked at earnings per share. Calculated it was $4 each was for an EBIT. Well, so what are they asking here? So how many common shares will be outstanding if they sell common shares to raise funds? So they give you a lot of information here, don't they?
I mean, would it be A?
How many shares will be out? Okay, why do you say A?
The common shares outstanding.
All right.
That's all they have outstanding couldn't be higher than A.
This says how many common shares will be outstanding if they sell common shares to raise the funds. How much funds do they need to raise?
2.5 million.
Okay. And what's the price per share they're going to sell it at?
$50.
So how many shares do you need to sell at $50 in order to raise 2.5 million?
50,000.
How many shares do they have outstanding?
100,000.
So how many shares? Huh?
150.
Then is the C.
Let's try C. Okay. So I gave you a lot of stuff here you don't really need to answer the question. All right, bonds are backed simply by the general assets of the corp, carrying no specific pledge of assets. They're referred to as A. Ventures. Okay. Oh, here's another one. What is their current return on equity and earnings per share? So how do you calculate return on equity?
Divided by equity.
All right, so what's their ROE?
20. So it's either B or C.
Which one?
C,
Think C? Why'd you say C?
How do you calculate earnings per share? Would be
You know it's B or C.
shares divided by the price or the income.
Right, by earnings per share. So what are their earnings? How many shares? Okay, we're almost there. Fair value is complicated because no ready market exists for trading in insurers. Calculate the fair value of the reserves. A present value discount is used, and a what?
B,
B. Okay. Why'd you say B?
because it's added to the fair market liabilities.
Is that
fair
a question? Or, is that a question or a statement?
Statement.
Okay. There's a tone of voice there, like, really? Okay. All right, number 18. B.
D is in dog.
D is in dog. 3-year bond issue. All right, let's see how we did. Maybe we'll see a bid.
Not bad.
Not bad.
That one.
Yep. So what's their cost of raising capital? All right, so look at it this way. So they're $100 par value. The shares are sold at $90 a share.
Thank you. That 1 million, just do that number in.
Do what?
They just do that number, that 1 million in.
Yeah, they just do the million in. You don't really need it. So how do you get 11.1%?
You did it in divided
Dividend divided by what?
the market price, which is $90 per share.
So you took
You take it.
90 divided by 0.1?
0.1 divided by 90,
0.1 divided by 90? All right.
or 0.01. And then $100 per share doesn't even matter either.
Okay. All right, so you're saying take your, you're saying taking 0.10 divided by 90? Or you're selling it at a, right? All right, so,
They say that's how they just stated it. They actually give you the way of doing it.
you did what?
They actually give you the way to do it when they tell you why you're wrong.
Okay, all right, so the dividend, which is 10% divided by the market price, or $90. Shares sold at $90 a share. So you're not using the 100, right? You're using the $90, right? Okay. And I think that Yep, that was it. Good job. That is it for chapter 10.
It's a hard chapter.
It was interesting. Let's put it that way. So no class next week, and then the following week, Wednesday, November 18, we'll do chapters 11 and 12.
Thanks.
Okay?
Thank you, Tim.
Have a good
Thanks.
night.
Good night.